Hey everyone, welcome back to another episode. So, there is a lot that has been happening on the market. So, volatility has been extremely high. The stock market had been falling over the last week or two, and it was crazy. The S&P and the Nasdaq indexes were both down by 3 and 5% respectively over the previous month. So it's crazy exactly what's happening. There's a lot to impact, and we're going to dive deep into it. So, with everything that's happening in the United States right now, interest rates are currently fixed, so they have not moved since Donald Trump has taken office. On top of that, inflation is actually high. It's at 3% again, and Trump had actually been increasing the talks of tariffs. So there was trade wars that could actually happen both on US soil, so that is between US and Mexico and US and Canada, and also on international soil, so countries across the water, so countries such as Europe, China, Asia, Australia, so forth. And it is crazy. So with the uncertainty of what has been happening, investors really have been fearful, and so they've been selling off, to put it quite frank, the actual stocks. And so there is a lot of actually undervalued stocks on the market right now. But before you run and go and purchase that stock that you have been having your eye on, the first thing that you want to do is you want to actually assess the environment, assess everything that's happening right now. And as it stands, the volatility is high. So the stock actually had traded up on March 5th, 2025. And this is actually good news considering that it has been down for the past week or two. So how do you protect yourself against high volatility in environments? The first protection that you can do is you can actually trade options. And options really is just the right but not the obligation to buy or sell a particular company or stock. And if you'd like to know more about options, I'll link that episode at the end of this video so you can actually check it out, which is options the way to go. And another way to actually protect yourself against what is happening in the markets is to just be consistent. So you can use the dollar cost averaging method, which is actually my favorite method of trading right now, and that is you just purchase a particular stock or two, and you just purchase over a set period of time, whether your goal is monthly, weekly, twice a week, every quarter. You just keep purchasing the stock regardless of stock price, and you actually would be able to really be purchasing at a lower cost in the long run. And that's my preferred and most favored method of trading right now, because it adds into the habit, and it also allows for you to get stock more units at a cheaper price. Because if you're consistently investing the same amount, and one point the market is down and another point it's high, then you would actually be getting more units when it's down and less when it's high. And the aim is that when the market is down, it actually covers for when the market is high, so it kind of balances and cancels it out. And that's really the aim of dollar cost averaging. And I'll link that video as well at the end too, so you can check out for more information on dollar cost averaging. And so that's one that you can go, and it's on value trading in that episode. And another method that you can consider adding to your portfolio is actually shorting the market. Now, a lot of investors have done this. I've never actually shorted the market myself personally, but I do know people who have shorted the market and they have done really well with it. And shorting really is just you selling the stocks that you don't have. So when markets are falling, so that's when investors tend to short. So during bearish markets, so if you have a market that has been falling, let's say 1 to 2% each week over the last 2 weeks, then naturally you would start to short the market, so that as time goes by, you'd actually be earning as the funds drops, and then you just sell out when you are done shorting or when you think the market will start to recover, and then you cash out. So that's essentially buying back the stocks cheaper, and that spread is what you get as profit. So those are just a few tips and methods that you can add to your portfolio if not yet added. And also, you might be thinking, I'm not really interested in investing in the stock market right now because the volatility is too high. And by all means, that is understandable. And you can actually consider bonds and treasury bills. So right now, the bonds market is actually doing well. So the 10-year treasury bond market is actually at about 4.28, 4.3% right now. So what that means is that it's still pretty close to the actual interest rates, and it's not much further than the actual interest rates that the bond market has been over a few months ago. So what that really means is that by purchasing a 10-year treasury, you actually would be getting a fixed income over time, fixed payment. So that would be coupon rates that you'd be getting. And also with that, you would also have a lot less volatility to deal with, because with bonds, you just purchase into the asset at a particular price, you get your coupon payments, and at the end of the tenure, you get back your initial investment. So that's the beauty with bonds. And treasury bills is the same thing. It's just that instead of actually paying coupons, you get the interest paid at the end of the treasury bill. So a 3-year treasury is at about 4.3% right now, which is actually great considering that the volatility in the market has been high. And so by purchasing treasuries, 3-month treasuries, you can just put it on an auto roll system. So if you have $1 million, for instance, and you invest it in the treasuries, you'd be getting, in essence, 4.3%, and it's just every 3 months you'll be getting that. So it's at 90 days of the 4.3%. So it actually works out to be a little bit more, in the sense that if you reinvest the interest rates along with the initial investment. So that's how you can add a little bit more to the actual investment. Now, if you decide to withdraw the interest and just keep the initial amount invested, then that's fine also, and it would be the standard 4.3% that you'd earn. So it wouldn't be compounding, and you really want to have the compounding effect paid over. So that is really the beauty of it. Now, the last thing is that you might also want to consider gold and silver investment. So gold and silver right now has been doing really well over the past week, month, 6 months, 5 years, and 10 years. So gold has actually been increasing by about 1 to 30%, depending on the tenure that you look at. So over the past day or two, it would have increased about 1%, while over the past 5 years, it increased about 30-40%. And silver has not been far behind. So they have both been increasing and growing at around the same level, which is phenomenal considering that a few years ago silver was actually at one of the lowest points it has been in a very long time. No, it's not the lowest point ever, but it's just a low point that it has been at in a long stage of time. So if you check back the silver prices 10, 20, 30 years, then you notice that the last 3 to 5 years silver was severely undervalued. And so with silver now rising at almost the same rate as gold, this is great news for the markets, especially the commodities market and silver in general. And so what this really means is that investors, if you are not able to afford the actual gold, so whether it's an ounce of gold or a kilo of gold, but you still would like to have exposure into the commodities market, then silver is a much cheaper alternative, and it is growing at around the same rate as gold. So it might not be of the same standard and quality and class of gold, but it still is giving you that exposure and that hedge against the actual currency, and also giving you the option to keep your money or move your money outside of the financial system, which in essence is what you really want to have as an investor. So you want to have more money in the system and out of the system. So in the event that something should occur and you're unable to have access to the funds, or you're unable to have the value of the funds, then you would at least want to ensure that you have some amount of your funds in an asset that can actually be used across borders and across different countries. So as we continue in the investing and we look at exactly what is happening with the volatility, you want to ensure that you are protecting your investments, keeping your strategy and sticking to your strategy as much as possible. And the best way to protect against the investment is by having that winning strategy, and also by adding one of the methods which we shared in this video, whether it's dollar cost averaging, whether it is to actually short the market, or whether it's just to purchase options. So these are a few strategies that can be added into the strategy to ensure that you are getting the most out of the market and having the least amount of risk as the fluctuations in the markets continue to rise and to occur, and the swings are being bigger and bigger. And also, as it stands right now, the market is still in a fearful state. So it's currently at 23 as stated by the CNN's Fear and Greed Index. And so what this means is that investors are still fearful, and so money is still not flowing in the markets and in the system as much as persons would hope for it to be. And so as the confidence is still not there in the markets, investors are moving monies to other asset classes and other types of assets. So bonds, for instance, has been seeing a growth in funds. Treasury bills have been also increasing, with the treasury bill rate right now still above 4%. Then this is still great news for investors, especially those who have a very short and limited time span in which they want to have those funds tied up for. Then 3 months and 6 months then treasury bills are the way to go. And for those seeking less volatility in the markets, then treasury notes, so the 5 year, 10 years treasury bonds are ways in which to consider. And also gold and silver, if you would like to take your funds and hedge against market fluctuations, hedge against that actual currency, then gold and silver is definitely one of the best assets and classes to consider, to just have that additional protection of your actual funds and wealth. Because really and truly, gold and silver is considered the wealth of the rich. And if we really are striving to be like the rich, then why not invest in assets that the rich do invest in? And so gold and silver is one to definitely have on your radar. And if you have not yet considered or even thought about exposing your portfolio to this asset class, the commodities asset class, gold and silver in particular, and this is one that you can definitely start to think about, start doing more research on, and just really start investing in. Thank you guys so much for tuning into this episode. Feel free to, if you like this content, feel free to give us a heart wherever you consume this material. Leave any comments down below. I love when you get in touch with me. And feel free to share this episode with a friend, family member, or loved one who you think would be benefiting from the information spoken about here. And also give us a follow or subscribe wherever you consume this material, so that you do not miss out on any new episodes as soon as they are launched. Until next time, take care. Love you guys. Hey.